Let's start with Tom Lee because holy moly, you have to hear this. He basically reiterates everything that we've been saying here on this channel for the last couple of weeks. What he says is specifically very bullish for Tesla stock, because Tesla is kind of like a small and mid-cap stock in terms of interest rate sensitivity, in terms of growth in their business, but it does have a degree of safety in which I think will be highly valued and will attract a lot of money into Tesla in 2024. Now, we'll talk about that a little bit later on into this video. Well, we will also look at is my Q4 delivery estimates for Tesla. Now, the last 2 quarters, I mean, I don't want to pat myself on the back, but I've been spot on the last 2 quarters. Wall Street has been way off. Basically, everyone else has been way off. And the way that I calculate delivery numbers, I could see an over 500,000 delivery number coming in about 10 days. As high as, well, we'll talk about it here in this video. And what the implications would be, what Tesla stock would do if that number does come out. So let's go ahead and get into it, guys. Hit that like button and subscribe to the channel. Let me know what you guys think about this down below in the comment section. And congratulations if you are watching this video on Christmas Eve. Dude, you better give yourself a pat on the back. Because, wow, not a lot of people are going to have your kind of dedication. Your kind of dedication will pay dividends forever. And, yeah, that's a very exciting thing. Thank you guys for joining me. Let's go ahead and get started.
Pretty much everyone got it wrong, except for that guy. Fundstrat's Tom Lee, a.k.a. the Oracle of Optimism, a.k.a. the guy who got it right, a.k.a. Tom Lee, not the drummer. He predicted the S&P 500 would end the year at 4,750. That means that if the S&P, folks, falls just a tiny 5 points next week, we got 4 days of trading left in the year, Tom could literally be exactly right. Wouldn't that be something? So let's bring in Tom, who, you can smile. It's kind of the Tom Lee version of a smile, but, you got it really right. And the basic question is how? What did you see that all these really nice, by the way, but really highly paid and really wrong strategists at the big houses got it wrong?
Hi, Brian. Thanks for that intro. I think there were 2 things that we were different from the street. The first is we didn't think inflation would take a decade to defeat. I think many were bracing for 10 years of Fed fighting inflation so stocks would get stuck. And the second was because of the inverted yield curve, many were predicting a hard landing in 2023. Our view was that inflation was going to fall like a rock this year, and the Fed therefore could take its foot off the fight, and that economic resilience and the fact that companies were bracing for this storm of hikes actually could avoid a recession. And so I think that kept us optimistic, and that stocks would look like 1982 and rebound to all-time highs very quickly, which it looks like it's happened.
So again, not to belittle, but why did you think that inflation was going to drop? Because if that is the basis of your thesis, others also got that wrong. What did you see in the data that made you think, when things were just cooking inflation-wise at the beginning of the year, that they would slow down?
Well, Brian, it's a little. What our team did was we rejiggered inflation and identified that 86% of all this rise in core inflation was coming from housing and cars, including the fact that super core was rising. Almost all that was auto insurance, auto repair, auto leasing. So we realized that this was all just following goods pricing, that car prices were set to fall, and that would pull down inflation. It looks like that's kicking in now. And that housing just needed to get towards a 3 to 4% annualized rate, and that would get you back to where you need to be to get to 2% core inflation. So our view was, it's not about travel and it's not about health insurance. It's really about cars and housing getting back to normal. And that's the trajectory we've been seeing. I think the market's recognizing that view, but we spent most of the last 18 months arguing that view.
What are you looking at for next year, Tom?
I think it's going to feel like a lot of tailwinds coming together, because we know the Fed is going to be supportive, managing the business cycle instead of fighting inflation. And We've identified reasons for capital spending to pick up next year, including that huge gap between soft and hard data, and that should lead to EPS surprise. And then mortgage rates, we think, could drop towards low fives, maybe even fours next year, and that would be stimulative to the consumer. So to me, it feels like it could be an early cycle year that really benefits financials and small caps.
But you don't see the S&P 500 gaining another 20%, do you?
It's possible, but that's not our base case. We think it's going to gain at least 10% towards 5,200, but it probably means you first consolidate a lot of this parabolic rise in the first half. So maybe we fall to 4,300, but then we rally pretty hard into 5,200 by year end.
But you think that small caps could outperform the large caps next year? Did I hear you right?
That's right. Yeah, I think small caps might even just rise every month next year because on a price-to-book basis, they're back to 1999 levels relative to the S&P, and that was a launch point where small caps outperformed for 12 consecutive years. So I think we're entering a period where small caps and market breadth are going to expand, and that's going to be good for stock pickers because they can buy companies they like, and you're going to have a decent earnings backdrop as well.
Yeah, there's a lot of companies out there, and we're not allowed to own individual companies. I can own index funds and ETFs and mutual funds. That's pretty much about it. But when I look at some of these screeners that I'll do just because I'm bored and I'm boring, I'm like, man, there's a lot of seemingly really good growth companies that are trading at like 4 times earnings in small caps.
That's
completely
right.
Just left on the trash heap.
That's right. I mean, the money's been equities have been starved of inflows. Retail investors pulled money out of stocks this year. And in fact, the S&P ex-FANG is trading at 15 times forward earnings. I mean, that itself is a pretty reasonable multiple. But then when you look at the S&P 600, which is the small cap index, you're at 12 times. So you're absolutely right. Small caps are pretty attractive.
I don't think Tom Lee could be any more correct. He says next year small caps might just rally every month of the year. Just a continuous rally. One, because valuations are very low for small cap stocks. Remember, normally small caps trade at higher valuations than like an S&P 500 because they grow into their valuation. So like what Tom Lee said, small cap stocks are trading around a 12 PE. The S&P 500 is 19. So there is a big valuation difference there. And really, small caps should be trading at like a 19 or a 20. The S&P should probably be at like 17, right? 18 maybe. Small caps could even be justified 21, 22, 23 times earnings because they grow into their valuation. Now, when rates go to 5.5% and you can get a risk-free return of 5.5%, 5% for the next 10 years, it doesn't make sense to invest in a lot of small cap stocks. And liquidity has been drained of this market or drained out of this market. That is drastically going to change in 2024. So as per my calculations, there's about 6.2 trillion in money market funds. That is money that is very liquid that could be moved to stocks in a relatively short amount of time. There is roughly around $10 trillion or so in bonds out there that have been bought over the past year or so that are likely break even or slightly profitable on their dollar basis. That would be like looking at TLT for an example. All right. This is the ETF that tracks 20-year treasury. Not the exact pricing, but you can get a pretty good idea. So treasuries, now that they're back up here, anyone that bought since basically September of 2022 is either close to break even or profitable on their bonds, especially anyone that bought between July and now have now, made money. At one point, bonds were just getting obliterated, like stupidly obliterated. Okay. So this bounce can open the door for a lot of, money to head back into markets, at least to be able to sell your bonds at a profit, because you don't want to sell your bonds at a loss and then put your money into markets. No, a lot of funds are going to wait until the bonds are at least profitable on the actual dollar face value amount, and then they'll think about selling their bonds. So I think that could open the door for about $10 trillion to head back into our markets. If you think about the government itself, they've raised about $2 trillion worth of bonds. Other buyers have added, many, many more trillions as well in there. Now, that's putting you at about $16 trillion. There's about $4 trillion, as per some of my estimates, of cash on the sidelines. That could be cash in citizens' bank accounts. That could be cash in other people's brokerage accounts. That's money that's not in money market funds. I got, thousands of dollars in cash in my brokerage account. You probably do too, right? That's taking all of that money into that $4 trillion calculation. You could be looking at about $20 trillion on the sidelines. If you get a fraction of that coming into our markets, that is going to be huge for a stock like Tesla or small and mid cap stocks. Let me throw this statistic at you. The total market cap of the Russell 2000 is $2.23 trillion, smaller than Apple and smaller than Microsoft. So all of your small caps put together don't even equal an Apple, don't even equal a Microsoft. So these names can run big time when capital does come back into our markets. And some people think it's when the Fed says they're done cutting rates. Some people think or are done raising rates. Just the algos might start to push money back into stocks, which is probably reasonable. Or it, could be the first rate cut. All right, that brings a lot of money into our markets, like trillions of dollars. We've seen the start of this, and it feels good so far, but there is a lot more money left to come back into our markets. So definitely want to be watching this situation. And what Tom Lee says, I agree completely. So without rehashing, why I think Tesla is going to new all-time highs next year, potentially as high as $500, $600 per share next year, I'll just tell it to you like this. Tesla's margins will improve. Tesla is going to beat the estimates. Tesla's PE multiple is going to increase as money comes back into our markets, and funds want high growth, high quality, interest rate sensitivity, because as rates fall, interest rate sensitive names, that's a tailwind to help their business out. So those three things, vitally important. And that's the reason I think Tesla will massively outperform next year. Let's now get into my Q4 delivery estimate and why this estimate, this number will be so important for Tesla over the next coming 2 or 3 weeks or so. Analyst consensus estimates are 481,000 deliveries. It was 483,000 deliveries. Wall Street has lowered this, but Wall Street does not have even a clue what the numbers are actually going to be. Let's be honest. Wall Street is way off every single time. I think it was last time Wall Street was like 20,000 deliveries short of where Tesla actually came in. I believe Wall Street was expecting, even like Gary Black was expecting 440,000 deliveries. Tesla came in at 465,000 deliveries. We were the only one, literally the only one that called the last quarter. So Wall Street consensus is basically never right. Now, Troy Teslake says his delivery estimate is 477,000 vehicles. Now, he's lower than the estimate. I am not. See, the problem with trying to forecast where delivery numbers are going to be is we don't get a lot of data out of the US. So we're estimating about 165,000 deliveries for the US for Q4, about 10,000 deliveries for Canada, about 92,000 for Europe, 175,000 for China, and 33,000 for the rest of the world. So when you add this up, that's 477,000. These are Troy Teslake's estimates. So Europe data, pretty concise. Chinese data, pretty concise. Rest of the world can vary. Some countries are daily reporters or weekly reporters or monthly reporters, but this number is usually pretty concise as well. It's not one of those that kind of tends to move too much, right? We're usually around 30,000. Last quarter, we were 38,000 or so. for the actual rest of the world total, right? Just other markets. Now, US data, we just don't get reports, like literally at all. So it's really hard to calculate what this number is actually going to look like. The best way that I have been able to calculate this, the reason we have been so spot on the last 2 quarters, it's simple. It's so simple. It's so simple, it's stupid, okay? The US tends to deliver about 30% more vehicles than China. That's it. So if China delivered about 175,000 vehicles here, you times that by 0.30, you're going to get an additional 52,500 vehicles. Add that to the 175 number, and you're looking at US deliveries around 227,000. Now, that could be a little bit on the higher end. I think maybe 20% of a boost might be a little bit more reasonable. So we will go ahead and go with that. So 175,000 times 0.2. That's an additional 35,000 vehicles more than China. Add the 175 back, and you're looking at about 210,000 deliveries for Q4 in the US. Okay, then you add your 175 back. Then you add, I believe Canadian deliveries are around 12,000 this quarter, just based on some people that I've talked to out there. So I think it's a little bit higher on that front as well. So you're at 397,000 with the US, with China, with Canada. You go ahead and add the 92,000, and I'm rounding here, right? And you are at 489,000 deliveries. You're higher than Wall Street right there. You add the rest of the world to this, which I think might be a little bit on the lower side. Let's call it about 31,000. You're at 520,000 deliveries. Now, this might come to some of you guys as a little bit of a shocker. But honestly, I think it's quite realistic at this point. Now, why do I say that? Well, we've obviously seen lots of cars for Shanghai getting shipped out. We've seen Fremont is running at basically max capacity. The lot is filled day in and day out. Texas, same there as well. But what I've noticed and what I've done is actually look at the inventory numbers. I've been personally tracking this for the last couple of weeks specifically. And inventory is basically gone. There is no new inventory in my area in a 200-mile radius of where I am. And I've been looking at other demographics as well, like Seattle inventory is pretty low out there as well. The Georgia area, Florida area. So it seems like inventory is actually being run down quite a bit right now. And you're still getting the crank of output that, Tesla is still seeing. Now, I would not be surprised if the number comes in lower than 520,000, because if vehicles are sold but not delivered yet, they don't come in this number. So let's say a lot of people want to take advantage of the tax credit and they buy the vehicle, but they don't necessarily take delivery yet, but they actually fund the vehicle in 2023. But they get delivery in Q1. So you could get some rollover here. So don't be surprised if the number comes in around 500,000. I think that's a little bit more of a conservative estimate, in my personal opinion, more of a realistic estimate, around 500,000 vehicles. 520,000 would include probably 20,000 of a carryover effect into Q1. We know there's going to be some factory shutdowns, some upgrades as well happening to Fremont, and I believe Shanghai also. So that could help out Q1. But based on what I'm seeing, based on my, way of estimating delivery numbers, there you have it. I would call it between 500 and 520,000 in that range. 510,000. That could could make sense, just meeting in the middle there. But I'm considerably higher than Wall Street yet again. I was considerably higher than Wall Street last time around. And honestly, I think this is pretty dang accurate. Now, I believe as well, a lot of people in the US that maybe were in the market to buy a Tesla for the tax credit, for tax credit purposes, are likely rushing to do that right now. At least I've talked to a couple people in my area, and shoot, I live in Michigan, so I'm like far from Texas. I'm far from California. Most people don't even know about Teslas in my area. So for me to hear about people, saying they're buying Tesla or buying a Tesla for the tax credit in my area, I can only imagine what's going on elsewhere. And I've, again, just seen the inventory rundown. So these are my estimates. Now, what will this do for Tesla stock? Well, if my estimate is correct, let's call it 500,000. We're going to come in about 17,000 higher than Wall Street's estimates. Last time, Tesla came in 25,000 higher than Wall Street's estimates. So again, you could come in as high as 520,000 in my personal opinion. I wouldn't be shocked if that happened. I think most of Wall Street would be. I would not be. So on your actual year-end guidance of 1.8 million, you just need around, 100 or 475,000 deliveries. Right about there, and you're good. So this would be, almost 50,000 deliveries more. It's not going to be too crazy, of a beat. You're going to come in 1.85 million, right? Not a crazy big deal. But that will show that when Tesla says something, they actually mean it. That they're not just setting numbers out there for no reason. So that's going to add a lot of credibility to Tesla. And anything that they say in 2024 is going to be a little bit more credible. So I think you have that going for us. But I don't really think exceeding, the 1.8 million delivery number is going to be too crazy, right? Because we kind of already know they're going to hit that number anyways. A little bit higher, it's not going to do all too much as far as actually moving the stock. What it will do, what will move the stock, I think, is the demand. That's going to be a record quarter. This quarter is going to be a record quarter. How can you say Tesla's demand is slowing down when Tesla just gave you another record quarter? Almost in a row. Yeah, last quarter was not a record. The quarter before that was a record. So how can you still make that argument? If Tesla in 2023 has seen at least two record quarters, I don't think Q1 was a record quarter, although maybe my memories just can't remember it. But how can you say that? That's the general narrative here. How can you say Tesla's demand is slowing down? You can't. And I think that proves the bear thesis utterly incorrect. And I think that's a problem when there's a lot of people that are negative on Tesla, that are short on Tesla heading into 2024 as rates go lower. The last thing you want if you are short or if you are a bear is Tesla giving you record quarters, likely improve margins, because now we're going to have the Model 3 Highland, doing a lot of deliveries, especially for Europe, some for China. That is higher priced than the last Model 3. You've seen a lot of price increases in China, about 5 in the last 7 weeks or so. So that should all start to be accretive to margins. You've also seen other things like the film, $7,500 for the wrap, right? Other different products that Tesla has launched that could be incremental to helping, Tesla bringing more money, like just the color black on your Tesla, which is something like, hey, if I want the color black, I'm getting the color black. I'm not going to get white or what is it, silver that's free right now. If I want black, I'm going to get black. That's an extra $1,000. Those decisions on a massive scale with thousands of buyers can be accretive to margins, can start to boost things up quite a bit, the average selling price. So yeah, that's something we can also look forward to. And that's the last thing you want if you are short or negative on Tesla. And a lot of people that maybe aren't even short on Tesla are kind of on the sidelines. Like, should we buy Tesla in 2024? Is Tesla really going to have a terrible year like some people think? Or is Tesla going to have a record quarter and a good 2024? Are margins going to improve? That's important as well. Tesla beating on the estimate, showing good demand, opens the door for Tesla to be able to raise prices if demand continues to hold up. Odds are margins are also going to improve as well if they hit their estimates, showing good demand, so on and so forth. So that's where you get the rise in Tesla stock. Now, this catalyst could probably push Tesla into the 270s, 280s. That'd be my expectation. So really, I mean, that's not like a huge kind of jump. To get to 270, that would be a 7% increase. 280 would be an 11.5% increase. That's a pretty good gain for Tesla, but it's not, the biggest gain for Tesla by any means. Now, what we're also expecting here soon is FSD entering the Chinese market. And I think that is going to be another big catalyst. If these come around the same time, the beginning of January, that's where you get Tesla stock into the 300s, in my personal opinion. A lot of people have said, you said Tesla stock was going to be, 300 plus by the end of this month or in January. And that's still true. I still think by, January, mid-January, end of January, some point in January, Tesla stock will likely be in the 300s. Because of, what we're talking about here in this video, and just capital coming back into our markets. It's a very powerful thing when people have been on the sidelines for almost 2 years and there's almost $20 trillion of investable cash. If 10% of that comes back into our markets, $2 trillion, that's going to do wonders for Tesla, for your stock market. And that is, I think, a baseline expectation. $2 trillion coming back into our markets. I think on the higher end, we could see $5 or $6 trillion come back into our markets in a relatively short amount of time. And that is going to propel your interest rate sensitive names, your small and mid cap stocks. I don't think Apple, Microsoft, Google, Amazon, these names that have held up well, that have benefited largely from the Fed raising rates, are going to be the ones that really outperform in 2024. It's going to be small mid-cap stocks. It's going to be a stock like a Tesla that is high growth, high valuation, very capital intensive business that is not dependent on interest rates, but will get helped out a lot by the Fed lowering rates. Tesla's whole business is really dependent on rates, whether it's megapacks, whether it's solar, whether it's, power walls or cars, all of that. All of those things are financed items mostly. So, yeah, I don't know who said Tesla's going to do bad in 2024, but I don't know who they're trying to fool because, 6 rate cuts in 2024. Just imagine if the economy does start to look a little weak here. You're gonna see rates potentially at 2% by the end of 2024. You're gonna be looking at 50 basis point rate cuts. If that happens during a strong economy, if the economy holds up but inflation continues to fall and we actually get deflation like Cathie Woods expects, come on, give me a break. I think this quarter could be detrimental for Tesla if they miss, and could be a game changer if Tesla beats above 500,000 deliveries. Let me know what your estimate is down below in the comment section. Let me know what you guys think about all of this information down below in the comment section. What is your estimate for Q4 deliveries? Do you think small mid-cap stocks, a stock like a Tesla that is interest rate sensitive, do you think those names are going to be the ones to outperform? Are you buying those names? What names are you buying? Are you buying Tesla stock right now? What's your 2024 price target? Let me know all of that information. Thank you guys for watching. My name is Michael Tyler. If you guys want to come join the trading community, check out that link down below in the description of this video. Give yourself a gift. Come make some sweet, sweet profits with us. Obviously, guarantees to make profits are not there. You could lose all of your money. There's a lot of risk management that goes into it. There's a lot of discipline you have to be a part of that community. Those things are usually learned over time. Paper trading is a good place to start, but doesn't really give you that emotional aspect of it. So you could lose money. It's not a lottery ticket necessarily. There is work that has to be done. But if you are someone that wants to put in the work, that wants to make a difference in your portfolio, maybe in your lives, if, you know, some of these trades are truly life-changing for a lot of members in the community. If you guys want to give it a go, check out the link down below in the description of this video. Give yourself a gift here today. I know a lot of dads and dudes out there. Most of you guys are guys watching this video. About 92% are. So 8% of ladies. Maybe this is a little bit different. A lot of dudes just don't get a lot of gifts. So treat yourself. I think it's more important to, you know, spread the love anyways. Actually, funny story. Today, I had my 3-year-old daughter in the car, and we were getting McDonald's for breakfast. And I usually do if I remember to, but I usually pay for the car behind me too. And usually it's like $5, $10. Today it was $40.70. Like they were feeding their family. And I, you know, went through the window. They pulled me up into the second little slot there. Of course, they pulled the car up right next to me in the other slot as we're waiting for food, and nothing happens. We kind of like look at each other, and then they like roll down the window. Have me roll down the window, and they're like, "Merry Christmas, thank you." They're like, "We couldn't afford, you know, a big Christmas dinner, so we were just doing this today," and I think that's a great, you know, learning moment for a lot of young kids too. So, gosh, kind of getting emotional there. Yeah. So, yeah, let's do the right thing. Today is definitely a sad day for a lot of people. So, yeah, I don't know where I'm really going with that. I don't want to get too lost in the sauce here, baby. Game time, almost 2024. We got to get ready. So that's gonna do it, guys. Thank you for watching. Enjoy the rest of your day, and I will see you in the next one.